The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Hello there, and welcome to Talk Tech from Progressive with George O'Connor and myself, Ian Robertson, the podcast where we talk about the UK small and mid-cap listed tech market and try and bring some facts and understanding to bear. So, George, what have you been up to these last few weeks?
Hey there, Ian. Lovely to chat. Ian, you've been hanging around the dark recesses of the tech industry again, as you've been exploring Constellation Software. So Constellation is a vertical market software company. This is a story and an investment case that is largely unknown, but super interesting. Ian, please share your thoughts.
Yes, I've titled the blog, it was called Software Tastes Like Chicken, and that's a quote from a guy called Robert Smith who set up Vista Equity Partners. He was thinking very much along the same lines as the guy who set up Constellation Software, which is a chap called Mark Leonard. And Mark Leonard's view was very much that we get very excited about all these hyper-growth software companies, but there are an awful lot of very interesting small software companies that are doing a good job for their customers, typically in vertical markets. They're not going to take over the world, but they are going to have a decent chunk of their little world. And if the VCs and such like aren't interested, then maybe there's a business case to rolling all these companies up. And that is really what Mark Leonard set about doing back in 1995. He was a VC in Canada, so he went off, talked to some of the larger funds in Canada, got some money, and set about building a business. Just going out and buying these nice VMS software businesses. Typically, they're looking at businesses that have an EBITDA of about $1 million, and then they're trying to buy them on an EV to sales of 1 to 1.5 times. And when you put those numbers together, you're looking at like a return of 20-25%. So what's wrong with that business model? If you don't have tech obsession running around your head and I've got to buy the latest thing, it's got to be bleeding edge, I've got to have mega growth, I've got to take over the world, it's a great story. And it has to be said that after what is now 25, 30 years, this business has come through. It is a $80 billion market cap company. People started to realize what it was about. People started to see how the compounding effect was working because it just kept churning off the cash from one model into the next and onwards. It just kept growing. It is a sprawling business, but they don't care. They split it up into divisions. They're all doing individually relatively simple jobs as effectively M&A guys, just buying companies, investing in companies. They don't have to go and do very much to these companies when they've bought them because there's not all that much to do because they're buying them from people who've been owning them for typically decades and who are either looking for an exit or looking for a strong partner. And with that, they just keep trundling along. The share price performance over the last 5 to 6 years has blown away the likes of Google, Meta, and Microsoft. This isn't an AI story. This is just a good, sensible business that people can understand. And I think it's very important for UK investors to look at it and think, well, why can't we do that in the UK? Why don't I, as a UK institutional investor, buy a nice little company like this? And then maybe the management will go and buy another one and then another one. Why are we so obsessed with having to have global winners and really exciting stories in the UK? Why don't we just say, here's a nice company. It's not going to take over the world. It can add on more companies alongside itself. It can grow into hundreds of millions of market cap. It could grow into billions in market cap. It doesn't have to go into battle with everybody. It may well end up going into battle against the likes of Constellation trying to find companies to buy. But that's a nicer place to be than trying to go head to head with Google, Microsoft, and Salesforce. We have to be realistic in this country. If we sit around on our hands waiting for the world-beating champion to come along, it isn't going to happen. We have to find ourselves nice businesses, float more nice businesses, show the world that we understand how software businesses work. And as that grows, other software companies may well actually want to come to the UK or list in their own market in the UK.
I have to be honest, Ian, just after I put down your piece, popped into my in tray was a piece of research by Silver Peak. Silver Peak being tech M&A advisors. What they're saying is that the US verticals group have just seen a strong rise on their valuations. They're outperforming all other categories in the tech space. So I think your timing on this one is perfect. I like them for three areas at the moment. First of all, these are blended business models because they don't explore and jump into the adjacencies. And there's really stories about not just the technology, but also the underlying business dynamics of their particular end market. What's media doing? What's capital markets doing? So investors have to factor that in as they create their investment cases. But you also have the other side in terms of the shape of those business models. So they have a revenue line that has a software bit, that has a maintenance bit, and has the implementation bit in there as well. And they have different dynamics and different calls in terms of cash on those companies. So these are not easy businesses to run, but also they've got greater touch points with their customers. And that gets me onto the second attribute around them. And particularly when you speak about the high growth businesses, because for us, the whole high growth business is really around the as a service gang, whether that's sort of, infrastructure, IaaS, or, software, SaaS, or platform PaaS. And the fact for that whole group, S doesn't mean service. It means subscription. These companies do very little to zero services. So that's where the vertical market guys score, but because they can understand that gap in terms of service delivery. Got another little thing as well around vertical tied into the Gen AI wave, whereby what we're seeing from the large language models is that they are rubbish at verticals. And they're rubbish at up-to-date and domain-specific data points. When I was looking at your research around Constellation, I was thinking of people like Relics, Capita, Pearson, Experian, Trustpilot, people that now own vertical markets today and sort of, culturally get the importance of vertical markets. So I think your timing is really interesting.
But it's interesting what you say about hard. It's probably not hard if you've been doing it for years. You understand how it works. Everybody talks to you. You talk to everybody. You're part of the industry, as it were, of which you're servicing as a vertical. That makes it extremely hard for somebody else to come into. But as far as you're concerned, the company, the small verticals market software company, that makes it relatively easy. And going back also through to this Gen AI, what's the challenge in getting something to write a script for you is to know what the script has to do. And the people who know what the script has to do are vertical market software companies who've been doing it for years.
Yeah. Ian, we're in week 2 of Q2. How has reporting season been for you?
Reporting season for me is relatively quiet. I've been looking over at the US and wondering what's happening with AI and who's spooking who. But I think comments upon who spooked who the most probably ought to wait until after next week when we've had Microsoft's results, when we've had Meta's results, when we had Amazon's results.
We've had some openers. So we had week 1, which was, of course, Netflix. And then for this week, we've started. So we had from Mag 7, we had Alphabet and Tesla. But what we did have is a flurry from the IT professional services side. So we had Tieto, we had IBM, Sopra, Coreforge. Tomorrow, we've got Capgemini. From infrastructure IT, we had Econocom. But I was captured on the IAS side of clearly Alphabet's got GCP, cracking set of results there. Also in terms of the IAS bit, SAP. But the surprise in the pack was UK listed Beeks. Beeks was flying along, revenue plus 27%. They had their FY results early this week. But I sort of fell in love with it because it came out on the Monday after the 19th of July. They had no outages, didn't break anyone's SLAs. What a great story there. So, Ian, we're starting to see some rotation out of Mag 7 into sort of Russell, small, mid-cap UK getting a little bit better. And we're seeing that from the TSR side. Now, that actually means funds are putting on more risk.
Well, I think when you said, what am I expecting for next week? I was thinking, oh, not much. I mean, what can I expect? We've gone through the story. Back in April, they were saying, oh, let's increase our CapEx. And they got some positive share price movements for saying that, unless they were Meta. Then this week, we've just seen Google say, oh, we're going to increase our CapEx, and they got a negative share price reaction. So I don't think they're going to be coming out and saying particularly much about anything, really, because what have they got new to say? And that's the question, though, for the US fund manager, isn't it? Where's the news flow? What's new? What am I waiting for? Am I going to see any evidence of AI generating anything? Well, no, not for a good few quarters. So why not go and find some news flow elsewhere? It's darn sight more interesting than buying into 7 stocks basically on the back of AI and an assumption.
Is it too early to be risk friendly, though, in terms of portfolio allocation? Because the good news of the Mag 7 is that they delivered so well.
They have delivered so well, but when you are looking for what's going to keep that 35, 40 times PE for NVIDIA up there, you're relying on the CapEx requirements from the likes of Google, Microsoft, and so on. And yes, they can afford it. They can't keep increasing their CapEx year after year in order to justify the sort of 35, 40, 45 times PE that NVIDIA is on.
I am reminded of, in the sort of immediate aftermath of .com, do you remember data centers?
I remember data centers.
There was a data center industry where they just kept on investing because, remember, everyone wanted to use the internet. And then in the sort of 02, 03 period, when people just stopped, suddenly we had this surplus of capacity. That gave the opportunity for people like Mike Tobin in the UK to build Telecity by going out and buying cheap data center capacity. 4 years later, that capacity has gone. The internet did deliver. And suddenly you can't buy these assets for love nor money. And of course, valuations have soared by then. And a certain part of me feels for the hyperscalers at the moment, where they were also through that and can remember the damned if you do, damned if you don't. You have sort of, sell side saying you must invest. Oh, by the way, if you are investing, then your depreciation numbers, now they must go up. So that's going to be impacting your profitability. But also, if you are investing, seeing what NVIDIA is doing in terms of its tech roadmap, the stuff that you're buying now is going to be obsolete in 8 months' time. Are you sure you should be doing this? And then the other side is we're still at test. And for Gen AI to really drive from the inference side, which should drive more volumes, we're not there yet. Sort of, full circle. IBM had a stunning print last night, and they said sort of Gen AI bookings are at 2 billion. So we are seeing it come through. Sopra Steria, Gen AI, 4,000 FTEs trained in it. They're training the entire company by year end 25. It is happening at an early test stage.
It's interesting because it sort of goes back many, many years to the whole mindset of Jensen Huang and NVIDIA as a consumer electronics, trying to cycle the product as quickly as possible. I've got to get this product to market. I've got to get my customers wanting their next generation product. Okay, it was present 20 odd years ago when we were talking about data centers and speeds and capacity. But the way in which he is churning his way through the products, it's getting people on edge in a way that he used to get the gamers on edge. So hats off to the guy. Going to the other extreme. Okay, I've just been talking about Constellation Software, which is turn the handle software. It's simple stuff. It's basic stuff. You understand the industry. You do what the customers want. You're not writing high-end code. You're not writing particularly sophisticated stuff, but you are delivering, and that provides the cash for you. The other end of the world is ASML. The ability to draw lines, to use a crude description, on semiconductor wafers at nanometer scale. The skills, the technology that's been built up over the years there is brilliant and deserves recognition. And I think perhaps in this country, we forget what technology can be. We spend a lot of time saying this is a great technology company, but I think we have to recognize what the gold standards are every now and again.
Brilliant. Very good. On that bombshell, Ian, thank you so much for your time and your research output. Again, great work.
Thank you, George.
Brought to you by Progressive Equity.